Welcome to today's episode of RHB Merge Money Chat, where we dive deep into the latest market trends and insights shaping the global economy. We are thrilled to have two distinguished guests joining us today. Firstly, we have Rasid, Vice President and Global Market Strategist based in Singapore. Raisah brings a wealth of expertise in delivering the latest market and economic views from the Global Market Insight Strategy team. Her insights are sure to provide valuable perspective on the current economic landscape. Joining her today is Mr. Toon, CIO and CEO of RHB Asset Management Singapore. With his extensive experience in asset management and investment strategy, Toon will share his expert view on navigating emerging market amidst the challenges posed by US tariff. We are excited to hear from both of these exceptional leaders in the financial world. Hi, thank you very much, Raisah, for making time for our interview today. It has been a really interesting every day, every weekend. We wake up with different news. So I observed that JP Morgan has recently said that based on their assessment, the probability for recession due to US tariff is 60% now, coinciding with the notable increase in the WIX index, commonly referred as the fear index. In your expert opinion, given this development, would you consider that the majority of the downside risk has been reflected in the current equity valuation? Please elaborate in your reasoning, particularly in the light of a market pricing dynamics.
Yeah, thanks very much, Nova. Just on the VIX. So the VIX, as you mentioned, the fear index, that's risen substantially over the whole policy uncertainty with regards to the latest industrial policies in the US. Now, the immediate reaction to all the flurry of the policies that we've seen is that de-rating that has taken place in the US equity market. Now, whether the equity market valuations have seen the worst really goes back to the nature of the shock that we're talking about. So unlike the previous crisis that we've seen, like the great financial crisis, those have been underpinned by some sort of imbalance in the US economy. Now, the US economy entering this year, however, was one that was resilient. The baseline view coming into this year was a soft landing for the US, but with the imposition of this tariff, firstly, this is higher than what we had expected initially, than what was announced during the campaign trail. And secondly, this would, as you mentioned, could have the potential to send the economy into a shallow recession, I should add, and in the second part of the year. So it really depends on what sort of level of tariff and the scope that we're talking about. And, we all have some sympathy that's really hard to call. So there's no proper comparison to this episode to any other recessionary periods that we have seen. The current shock is policy driven, meaning that we could see things turn fairly quickly with any announcement. And the last couple of weeks has been a very good demonstration of that. So let's take stock of what happened, right? We've seen a market correction in the equity markets in the US and also to some extent the bond market as well. But just focusing on the equity market, you've seen that sort of de-rating taking place in the S&P 500, as you can see on the left chart. And this is to be expected. You see that markets will reprice equities to what they think would be most reflective of current market conditions. Meanwhile, if you just look at US earnings, those have not moved as quickly as companies have not made decisions to change their capital expenditure plans as yet. So the real dollar and cents impact, those will come later on. So what do we do in such a scenario when you're thinking that uncertainties will be very common, and what does it do for our macro investing narrative principle? So a couple of key points. Your portfolio should remain balanced and well diversified. Number two, there's still structural factors such as AI that could support US equities in longer term. So such pullback could be a good opportunity to add exposure to US equities gradually. And one narrative that we think that's pretty much intact is the broadening of earnings growth in the US, as you can see on the top right chart on this slide, where we do see a catch up in the S&P 500, excluding the top 10 stocks. And finally, perhaps the most important point of all is that it is very difficult to time the markets. And again, this is a very headline policy-driven shock. So time out of the market could be an opportunity lost. So stay invested, do not time the market. These are very fundamental yet very important investing principles, especially if you're a long-term investor. And the past 2 weeks have been the perfect illustration of this principle, as you can see how volatile market performance has been.
Okay, very good. In terms of the introduction of the reciprocal tariff that has been widely regarded as a strategic mechanism to facilitate negotiation for more favorable trade agreement, However, in a surprising late night announcement, US has decided to delay the full implementation of this tariff by 90 days. While latest news also see US has spared smartphones, computer, and other electronics from China tariff. Based on this development, do you think it's possible that the complete rollout of the tariff regime might ultimately be avoided? Kindly provide your perspective on the likelihood and potential market implications.
Yeah, that's a very good question. Again, I think it's very important to stress that what we're seeing right now is a policy-driven shock rather than something that is fundamentally a drag in the economy, whether is it in the corporate sector or the household sector. So right now, after events of the last couple of weeks, and specifically on the pause of the reciprocal tariffs and exclusion of some of the industrial and consumer electronics as what was announced on April 12th, where we stand right now on the effective tariff rate, that actually brings it down to about 23%, down from about north of 30%, which we saw when all the reciprocal tariffs were being imposed. Now, the current tariff rate now is still higher than what we've seen since the pre-war period, which really gives you a sense of the paradigm that we're operating in, as you can see on this chart here. Now, if you just take a step back and think, what are the objectives of the tariffs? Now, one of this is to reduce the trade deficit of the US with key trading partners. Another objective could also to bring manufacturing jobs back to the US after decades of living in a globalized world, where countries have seek to gain comparative advantage. So certain countries in Asia are specializing in certain processes or produce certain products that the US do not. Or it could be a combination of both the objective. Now, will tariffs actually achieve the objectives? Perhaps, but not without a strong repercussion for the US economy, and especially the consumers in the form of the growth drag and inflation, since now the US consumers will need to pay higher, right, for importing foreign goods. So this is not the same as the 2018 tariff episode, where the price increase is being absorbed by retailers, your exporters, your importers, and the consumers didn't feel it. This time it's very different. You can see on the chart in front of you, the tariff rate that we're talking about now is jumping from 4% at the start of the year to about the mid 20% right now. So, and this is why we think that there could be some backpedaling on the tariffs as such we've seen of late. Now, the expectation is that during this 90-day pause, there will be a lot of negotiations taking place between leaders of the countries with the US, and countries will continue making a case to pledge concessions to reduce tariffs and non-tariff measure that could avoid us the worst case scenario. So putting a number on probability of will the tariffs actually be completely backpedaled, that's going to be challenging because it's going to hinge on how the macro environment and how the negotiation evolve. But what we think is the likelihood is that the tariff rate, when we calculate based on the reciprocal tariff, which was mentioned earlier, is higher than 30%. We do think that that could potentially be the ceiling, and the US administration will adopt a more targeted approach and really target certain products instead.
Raisah, just now you mentioned a little bit about investing, stay longer in the market, and some ideas about investing into technology. So maybe we can just reconsolidate that again. Like for
In
investor that has
right.
the in the investor that has the long-term investment horizon, where would you
Yeah.
recommend gradually accumulating position to optimize sustained growth in their portfolio? So can you specify some sector, asset class, or even geographical region that in your view is particularly promising? And if you put support with some of the rationale for your recommendation for the long-term value creation.
So in the chart in front of you, we have the performance of various asset classes across equities, fixed income, cash 60-40 portfolio for the 6 months, for the first 6 months following a recession. And then on the right chart, we do have those exact performances for the following 6 months. And what we do is that we have taken the performances over previous recession cycle as a guide. While we did caveat that this time is different, it's worth noting the relative performances of asset classes in terms of returns and volatility. Now, just a couple of points before we get into what the current environment means is that if you just use this as a guide. Now, the first point to note from this chart is that the bulk of the correction that takes place in the first 6 months. Now, we've touched a couple of points on this earlier. If you consider the range of equity returns across recessionary periods, compared to fixed income, for example, you see that the market performance for equities is much more volatile compared to fixed income. So you can reap some of the upside, but the downside would be more severe than that of the fixed income. Meanwhile, for fixed income, you will lose some of the upside, but the depth of the downside is shallower. Now, the third point is that if you just consider cash returns, those will be low. Even though volatility is low for cash, you can see on the right side of each of the chart that is in front of you, is that cash has typically only outperformed every asset class only when there's a broad market downturn, as it was the case in 2022. So what we tell investors is that staying invested in other instruments will offer you better returns. Now, in this current environment, where do you go? Again, the policy shock will be more apparent over time, but it's really important to diversify. Now, what does this actually mean in principle? It means several things. It means within the US equity space, it's important to stay invested in both US equities and international equities. So really taking advantage of some of the structural trends. Now, if we're thinking back to the tariff question, it's worth noting also that the tariffs are only on goods and not applied to services. So some of the markets that are more services oriented, so markets such as India, some parts of Asia, ASEAN, that really derive a bulk of their revenue that's sourced domestically, that could be slightly more insulated, even though the tradable sectors will be hit hard. And some of the valuations in the equity market, for example, they do offer compelling points. If you look over in Europe, right now we're talking about more fiscal acceleration. It's not a near-term story. It will take multi-year story. So that could also be something that you look at that could be interesting. Within the US space, so bringing it back to the US, growth and technology remain very important. We don't lose sight of the fact that we are still talking about artificial intelligence. We may not necessarily be talking about it all the time, given all the airtime has really been tilted towards trade, but really it's a more longer term structural story that's really pretty much intact. Also, if you're talking about diversifying across asset classes, fixed income could be one as well. It could be challenging. Fixed income as a hedge. We have seen it in the early part of April where it didn't really work out as well. But just note that even if the correlation between fixed income and equities, those tend to be, if it is zero, that still is a hedge in itself. So diversification to really mitigate the downside. Also looking at option overlay strategies, especially during this volatile period, could look interesting. So I think long story short is diversify, and also really look into quality companies, whether is it in the equity space, whether it's in the fixed income space, and also look at more income-driven strategies such as your option overlay ones.
Yeah, thank you, Raisah. I just want to drill deeper a little bit into technology again, still, and could we like expand a little bit discussion to China? Given the technology sector has recently experienced significant decline, yes, concurrent advancement in AI, particularly within China, has garnered attention, like the lack of DeepSeek. In your assessment, does the investment thesis for AI and technology relevant, especially when comparing between US and Asia-based technology sector? Which do you believe offers superior prospect for growth, and what factor underpin your evaluation?
I think that's a great question. Just starting the US first. So as mentioned, the correction that we've seen in the US market, actually that has been concentrated in certain sectors. And those sectors are the ones that are more susceptible to tariffs. So you can see that happening in the tech companies, for example. And the very reason why this correction even took place is the very fact that there was market concentration in certain stocks, as you can see on this slide. Now, the structural narrative that we've had is that AI, artificial intelligence, is pretty much in place. So unlike tariffs, however, where things can change on the day, the positive effects that comes from artificial intelligence, whether we're talking about the US or even China, that really take decades for us to really see the impact, for it to be more evident in the economy. Whether that's actually through an increase in productivity, and that really can improve profit margins for the US economy and even the Chinese economy, for example. So it is similar when you compare AI to something like the invention of personal computers, where it has taken a while for us to actually come on board. But if we just focus on things such as generative AI, which both China and the US have really made a lot of advancement in the last couple of years, we shouldn't really lose sight of the policy noise in the near term and really think about that longer term trend. On the next slide, you will also see that specifically for the US, the capital expenditure plans for the top technological companies in the US, so these are the more software-driven companies, that actually remains robust over the next couple of years. And this, again, to us, is a positive sign. And more importantly, is that the sort of companies that we're talking about now in this current AI is very different from what we saw during the 2002 tech bubble, where the balance sheets now in some of these top companies are actually a lot more robust than what we saw for the companies back in '02, for example. Now, obviously, the recent exemption for consumer and industrial electronics will support the view that growth and technology will continue to be a very important trend in the US. Now, what about China? Now, in China, we have seen green shoots in the tech company. You've mentioned some. We've seen a delivery of some of this AI software coming to light, and some of the earning potential of some of these Chinese companies is also quite constructive, and where valuations are still attractive. Now, with the long-standing drag from the property sector, the tech sector in China really offers investors a reprieve when you're looking at China beyond the very domestic-oriented sector. While it does appear to be, the Chinese policymakers appear to be more accommodative to tech companies for now, given recent events of the last couple of years, we still think that it's really important to remain diversified even when it comes to China. So I think the strategy here, we think, is to have exposure to both China and US when it comes to technology. I think US is a little bit more of a straightforward story in the sense that the companies there, they've made great strides. We've seen push from the US administration to really support the domestic industry. And again, remember, we've spoken about the importance of staying diversified across styles, geographies, and diversification across AI is the perfect example of such.
Thank you very much, Raisah, for sharing your insightful perspective on the global market trends and economic outlook. Your expertise has truly shed light on some key factors driving the current market environment. Now, let's turn our attention to emerging market and explore how US tariffs are impacting investment strategies in this region. To help us unpack this topic further, we are honored to have Mr. Tan Jitun with us today. Thank you for joining us today, Jitun. With China recently imposing a 125 retaliatory tariff on US goods, how do you see this escalation impacting China's economic path? Does Beijing's determination to fight to the end risk overburdening its domestic economy? Alternatively, do you believe that despite the tension, US and China leaders are actually on good speaking terms and will eventually reach a mutual agreement, thereby preventing further decline in the equity market?
Hi, Nova. I think we're definitely living in very interesting times. I think we need to bear in mind that this overall US-China tariff war is just part of a massive grand tariff negotiation and political maneuvering from both sides. I think we are just in the early days in terms of this US-China tariff war. It's important to understand that this is the start of opening gambit between these two countries. However, if this were to prolong, I think this will result in a lose-lose situation for both countries and, in fact, the world in general. It's also important to note that the US exports from China as part of total China GDP is only roughly about 3%, which is quite small in relation to the huge China GDP at this point in time. So I do think that China is very, very well positioned to negotiate with the Americans at this point in time. And in any case, if there is any slowdown in the economy due to this US-China tariff war, I do think that the Chinese government have ample measures that they can implement in order to stimulate and support the economy. So I wouldn't be worried too much about that.
Moving closer to our home country, US tariff range from 10 to 50% impacting ASEAN economies, particularly export-reliant nations like Vietnam and Cambodia. Which ASEAN countries are most vulnerable, and how does Malaysia position itself amidst these tariff pressures?
I think, Nova, you are quite right to point out that Cambodia and Vietnam are highly exposed to this US reciprocal tariff war. Roughly speaking, both Cambodia and Vietnam have roughly about 20% of their economy exposed to US exports. To a lesser extent, Malaysia and Thailand roughly have 10% of their economies exposed to US exports. However, I would like to point out that ASEAN is in a good place as China and US do want to maintain good relationship with the ASEAN nations. Specifically, I think over the course of the next few weeks, we will see China leadership coming over to ASEAN to visit its leaders in order to placate the leaders as well as to put in place policies that should benefit the ASEAN region.
Toon, given the US has imposed cumulative tariff of up to 145% on Chinese goods and up to 50% on ASEAN imports, is it feasible for US to sustain its economy without relying on goods from China and ASEAN? What might be the implication for US consumers and businesses?
For sure, the tariff will result in higher prices for US consumer and businesses, and therefore will result in higher inflation for the US economy. This is not something that the US administration would want. I do think that this is just once again an opening gambit by the US administration in order to negotiate with other countries all over the world. It is also important to understand that as a percentage of total US GDP, US imports actually account for roughly about 15%. This is certainly quite chunky if you view it in terms of the overall US GDP. It is not so easy to substitute the imports from China and ASEAN in the near term. So as such, it will result in inflation in the US.
Toon, you mentioned a little bit about the China stimulus plan. Do you expect Beijing will introduce aggressive plan specifically aimed at mitigating the economic slowdown caused by US tariff? If so, how effective are these measures likely to be in supporting its economy?
This is just early days yet in terms of the US-China tariff war. I do think that the Chinese government have sufficient stimulus measures that they can implement in order to support the China economy. At this juncture, we have yet to see concrete stimulus plans by the Chinese government. But having said that, I do think, like what I mentioned earlier, I think it's still early days in terms of the US-China tariff war. I think the senior China leadership is waiting for how this US-China tariff war would eventually pan out. The other thing that we are actually seeing is that the national team of China is starting to buy stocks in the Chinese stock market over the course of the last few days in order to support the share prices. This is certainly very welcome by the investors as we are starting to see Chinese stock market outperforming the global stock markets and in particular the US stock markets.
Toon, this is my last question. I think it's also the key question from our investors. Across China and Asia, are there particular sectors that could potentially benefit from the current tariff situation? Additionally, have recent price correction create an attractive opportunity for investment in any specific industry within the region?
For sure, the recent price correction did indeed give us a lot of attractive opportunities for us to pick up stocks in sectors that we deem as structurally attractive. This will include sectors that are self-reliant and have self-sufficiency as part of the overall investment themes. As a result of this US reciprocal tariff, we are expecting regional trading blocks to be formed over the course of time. In addition, we are also very positive on the Chinese technology sectors as well as certain Asian technology stocks that will continue to thrive despite the reciprocal tariff. Our view is that the artificial intelligence or the AI story continues to be intact and will continue to grow for the foreseeable future. Certain sectors, which will include the renewable energy, EV sectors, will also continue to outperform in this current climate, as these sectors are self-reliant and are self-sufficient within the China and Asia supply chain and are not dependent on the US economy. Last but not least, because of the volatility in the market, we expect more domestically exposed sectors and stocks to outperform the overall market in the short term.
Thank you, Toon, for your invaluable insight into emerging market and the implication of US tariff on investment strategies. Your expertise has provided our listener with a deeper understanding on how to navigate this challenging time. As we wrap our today's episode, we encourage investors to reach out to our relationship managers to review your investment portfolio. This is an opportune time to capitalize on rebalancing strategies that can help you optimize your investment during this time of market volatility. Thank you for tuning in, and we look forward to join us again in our next episode. Thank you, Toon.